Silver just crossed $74 an ounce, hovering near historic levels. Wall Street thinks this massive price surge will force miners to flood the market with new supply and crash the rally. They are dead wrong. Today, the world's largest silver mines in Mexico and Peru are actually shrinking production. The math behind global mining economics reveals a terrifying reality. Even if silver hits $100 tomorrow, the supply shortage cannot be stopped. Welcome to the inelastic supply crisis, the anomaly that changes everything. For decades, mainstream finance taught you a simple rule. When prices rise, production goes up. It is the basic law of supply and demand. But behind the headlines, a dark geological truth is emerging, and it is about to break the paper silver market forever. To understand why the silver market is fundamentally broken, we have to look deep into the Earth's crust. Wall Street traders look at charts, they analyze moving averages. They think silver responds to price signals just like any other commodity, but they are ignoring basic geology. According to official data from the Silver Institute, an astonishing 70% of the global silver supply does not come from primary silver mines. Let that sink in. Nearly 3/4 of all silver produced worldwide is actually a byproduct. It is a geological hitchhiker. It is the accidental waste material left behind during the industrial refining of three completely different base metals: copper, zinc, and lead. When major mining conglomerates dig into the earth, they're not looking for silver. They're targeting massive deposits of copper for electrical wiring or zinc for galvanizing steel. The silver they find is simply a bonus, a side effect. And this is where things get dangerous. To see the trap clearly, put yourself in the shoes of a CEO at a multi-billion-dollar mining giant like Freeport-McMoRan or Newmont. Silver prices just skyrocketed to $74 an ounce. Your board of directors wants more silver. The market is screaming for it. So what do? You look at your massive copper asset. Can you simply flip a switch, spend $2 billion and double your mining production just to extract that extra silver? The answer is absolutely not. Your entire business model, your heavy machinery, your logistics, and your profit margins are entirely tied to the global demand for copper. If the global economy is slowing down, if manufacturing indexes are contractionary, and if the demand for industrial copper is flatlining, you will not expand that mine. You cannot. To flood the market with copper just to chase $74 silver would crash your core copper business. It would be financial suicide. The exact same structural nightmare applies to zinc and lead. If automotive or construction demand drops in Europe and North America, zinc mining halts, and when zinc mining halts, global silver production vanishes with it. This means the global silver supply is effectively held hostage. It is trapped by the industrial cycles of completely unrelated base metals. In mainstream economics, this is called perfectly inelastic supply. The price of the asset can double, it can triple, it can hit $120 an ounce, but the physical output remains completely frozen. The supply curve cannot bend to match the demand. This is not a temporary market inefficiency. This is a structural deadlock. Look at the giants of the mining sector. Look at how they allocate capital. When Newmont manages its massive asset portfolio, silver is barely a footnote on the balance sheet. They manage their cash flows based on macro-industrial trends, not the silver squeeze. For decades, this byproduct dynamic worked in Wall Street's favor. Base metal production was booming, which kept a steady, artificial stream of silver flowing onto the market. It created a dangerous illusion of abundance. It allowed institutional banks to issue endless paper contracts, shorting the market, confident that the physical metal would always show up to back their bets. because behind the headlines, everyone assumed that if scarcity ever became real, the mining sector would just dig faster. But that's not the real story. You cannot dig faster when your hands are tied by the laws of geology. You cannot create a primary silver industry out of thin air when the planet itself did not distribute the metal that way. So while retail investors watch the spot price and while algorithmic trading bots shuffle paper claims back and forth on the COMEX, the physical reality is tightening like a vice.
The Western financial system has spent years pricing silver as a mere shadow of gold, a secondary speculative asset for retail savers. But the physical industrial complex requires silver as an absolute, non-negotiable necessity, and they are relying on a supply chain that is fundamentally incapable of growing. The price of silver is independent, but the production of silver is entirely dependent on global industrial production. The trap is set. Wall Street has sold paper promises based on an elastic world that does not exist. And as global base metal mining faces its own structural headwinds, the unintended consequence is a permanent chokehold on the silver market. So Wall Street looks at the byproduct trap and pivots to their fallback plan. They believe the primary silver mines, the remaining 30% of operations dedicated entirely to pure silver, will simply scale up, shoulder the burden, and save the market. But that is where their math fails completely. Because behind the headlines, the primary silver industry is fighting a losing battle against geology and time. The first major crisis is ore grade degradation. For over a century, the world's heavy producers in Mexico, Peru, and Bolivia have scraped away the richest, highest-grade silver veins. What is left in the ground today is low-quality, low-yield rock. Data from mining reports reveals a devastating trend. Companies are forced to crush and process double the amount of earth just to extract the same single ounce of silver they did 20 years ago. You are burning twice the energy, utilizing twice the machinery for the exact same output. And this brings us to the brutal reality of the cost curve. According to comprehensive industry data from mining.com, the all-in sustaining cost, or AISC, for primary silver producers has skyrocketed to unprecedented highs. Think about what it takes to run a mega mine today. The heavy haul trucks, the massive grinding mills, the massive ventilation shafts deep underground. They all run on one thing: energy. Crude oil and industrial diesel prices have remained volatile and structurally elevated, inflating operational expenses by the minute. But it's not just fuel. Sovereign nations in South America are aggressively rewriting the rules. Resource nationalism is sweeping through Peru and Mexico. Governments are demanding higher environmental compliance taxes, stricter water usage permits, and stiffer penalties. At the same time, localized labor strikes are shutting down operations for weeks on end. The profit margin required to sustain a mining business is evaporating. Even with silver sitting at $74, these primary mines are barely breaking even on new exploration. And this is where things get dangerous for the paper shorts. The typical retail investor assumes that if prices stay high enough, new mining companies will just appear out of nowhere. They think capital solves everything. But you cannot finance your way out of a logistical bottleneck. Let's lay down the counterpoint to Wall Street's optimism. Today, the lead time required to bring a brand new Tier 1 silver mining project from initial geological discovery to its first commercial metal pour is a staggering 10 to 15 years. 10 to 15 years! The Western world has wrapped the mining sector in a suffocating web of regulatory red tape. Environmental, social, and governance mandates, the ESG protocols, mean securing an exploration permit alone can take up to 7 years. Then comes the engineering, then the localized infrastructure, then the construction of the processing facilities. No rescue supply is coming. There is no hidden emergency tap that can be turned on to alleviate the immediate stress on the vaults. The physical silver market is currently operating on borrowed time and depleted reserves. Every single ounce being consumed by global industry right now is draining the existing above-ground stockpiles because the active primary mine network cannot physically replace it fast enough. Wall Street treats silver like an infinite digital asset on a spreadsheet. They act as if a higher price tag instantly manifests physical atoms out of thin air. But the Earth does not care about paper contracts. The structural cost curve has set a permanent floor under the market, and the regulatory bottleneck has locked the gates shut. The supply side of the equation is effectively paralyzed for the next decade. And while mainstream analysts continue to tell the public that the market will rebalance itself as it always does, they are missing the ultimate trigger. Because the supply isn't just failing to grow, it's about to collide head-first with an industrial demand explosion unlike anything we have ever seen in human history. The supply side is locked. The geological bottleneck is real. But that is only half of the equation. Because while global production is frozen in place, global demand is moving at an exponential pace. Mainstream finance still talks about silver as a luxury asset. They look at jewelry, they look at silverware, they treat it like a secondary investment asset for retail savers. They are completely blind to the industrial transformation unfolding right before our eyes.
Silver is not just a precious metal. It is an absolute, irreplaceable technology metal. It possesses the highest electrical and thermal conductivity of any element on the periodic table. You cannot build the modern world without it. And right now, the global tech sector is turning into an unstoppable industrial vacuum, sucking every available physical ounce out of the market. Look at the green energy transition. The massive rollout of solar energy across North America and Europe relies entirely on silver paste to conduct electricity within the cells. The latest generation, the N-type solar panels, requires up to 80% more silver per watt than older models. At the same time, the automotive landscape is shifting. Every single electric vehicle uses double the amount of silver found in a traditional internal combustion engine, embedded deep within the advanced battery management systems and autonomous sensors. Add the global expansion of 5G infrastructure, high-frequency telecommunications, and advanced aerospace engineering. But there is a new monster entering the room: artificial intelligence. The hyperscale data centers built by Microsoft, Google, and Amazon require millions of new semiconductor chips and high-capacity electrical transformers to process AI workloads. Every single one of those chips, every cooling system, and every deep grid power component relies on silver infrastructure to function without overheating. The industrial demand is non-negotiable. It is recession-resistant. Apple, Tesla, and Nvidia cannot stall production lines just because silver prices are volatile. They must have the physical metal. And this is where things get dangerous. Because despite this massive wave of physical demand, the large financial institutions at COMEX and Wall Street are suffering from severe risk numbness. They are living in a state of cognitive dissonance. Institutional market makers continue to issue hundreds of millions of ounces in paper short contracts, keeping the digital price artificially suppressed. They look at their spreadsheets and see plenty of digital liquidity. They are completely ignoring the empty vault floors. They believe they can settle their bets in fiat currency indefinitely. They assume that a higher cash payout will always satisfy a contract holder. But a tech manufacturing giant cannot run a factory on digital dollars. You cannot build a solar panel out of a paper credit. You cannot wire an AI server room with a cash settlement. This sets the stage for the ultimate future scenario, a structural squeeze that cannot be manipulated away. Imagine the moment a major global manufacturer, a sovereign buyer, or an automotive conglomerate looks at the depleted COMEX inventory and realizes the physical metal is running out. They hold a massive paper contract for silver delivery. Instead of taking a cash profit and rolling the contract forward, they demand delivery. They want the real physical metal shipped to their factory doors, and the exchange cannot fulfill it. That single event triggers a physical delivery race. The moment one massive tech producer moves to secure their physical supply chain, every other major corporation will panic. Apple, Samsung, the defense contractors, they will all scramble for real metal simultaneously to protect their operations from shutting down. The paper pricing system will fracture entirely. When a market shifts from paper-driven pricing to physical-driven pricing, the true value of a finite, indispensable industrial asset is exposed. The investment community thinks the silver story is about retail FOMO or currency debasement, but that's not the real story. The real story is a massive collision course between an inelastic, geologically constrained supply and an absolute, unstoppable technological necessity. The financial elite are asleep at the wheel, comfortable in their digital illusions, but the physical world is about to reassert itself with absolute force. $74 an ounce is not the ceiling, it is just the wake-up call. This historic price surge is not a speculative bubble driven by retail hype or temporary market mania. It is the opening chapter of a systemic failure, the total collapse of a paper pricing mechanism under the absolute weight of global geology. The Western financial matrix spent decades treating silver as an infinite digital abstraction, but the laws of mining mathematics do not care about Wall Street algorithms. You cannot build the infrastructure of tomorrow out of paper IOUs. And this is where things get dangerous for the average investor. When this massive leverage inevitably snaps under the pressure of real physical tech demand, where will your wealth actually be? Will it be sitting on a digital balance sheet, trapped inside an exchange default clause, or will it be secured in tangible, physical hard assets that the world desperately needs to function? The mathematical reality of mining economics does not lie. Let me know your thoughts in the comments below. Will technology giants be forced to directly buy out mining operations just to protect their own supply chains? Hit the like button, subscribe, and turn on notifications to stay ahead of the macro shift. Choose your assets wisely. Thank you for watching.